Over the last few months, something unusual has been happening in the stock market. While everyday investors continue to pour money into popular tech stocks like Apple, Microsoft, Nvidia, and Tesla, big institutional investors are quietly moving in the opposite direction. Billions of dollars are flowing out of the tech sector, and this is not happening by accident. The real question is why the smartest and most powerful investors in the world are selling while the crowd is still buying. Understanding this difference can completely change how you look at the market. When we talk about big investors, we are not referring to individual traders or social media influencers. These are hedge funds, pension funds, investment banks, and institutions that manage trillions of dollars. Their decisions are based on data, long-term cycles, and risk management, not emotions or hype. Historically, these investors tend to move early, well before major market shifts become obvious to the public. So when they start reducing exposure to a sector like technology, it is usually a strong signal that something beneath the surface is changing. One of the biggest reasons institutions are selling tech stocks is valuation. After years of massive growth, many tech companies are now trading at extremely high prices compared to their actual earnings. In simple terms, investors are paying today for profits that may or may not arrive years in the future. For big investors, this creates an imbalance where the downside risk becomes much larger than the upside reward. When expectations are already sky high, even small disappointments can lead to sharp declines. Locking in profits at elevated levels is often the smart move. Another major factor driving this shift is interest rates. Tech stocks are especially sensitive to higher interest rates because much of their value depends on future growth. When rates are low, future earnings look more attractive. But when rates stay high for longer, those future profits lose value in today's terms. Many investors expected quick rate cuts, but inflation has proven more stubborn than expected. Central banks are being cautious, and this environment puts pressure on growth-heavy sectors like technology. Artificial intelligence has also played a huge role in pushing tech stocks higher, but this is where reality starts to clash with hype. While AI is a powerful and transformative technology, the market has priced in enormous expectations very quickly. Big investors are now asking tough questions about profitability, costs, and long-term returns. Massive spending on AI infrastructure does not automatically translate into immediate profits. When excitement runs ahead of fundamentals, professional investors often choose to sell while enthusiasm is still strong. What many retail investors don't realize is that big money is not leaving the market altogether. Instead, it is rotating. Institutions are gradually shifting capital into sectors that tend to perform better during slower growth and higher interest rate environments. Areas like energy, financials, industrials, and defensive dividend stocks are starting to attract more attention. This rotation usually happens quietly, without headlines, and by the time it becomes obvious, much of the opportunity is already gone. For retail investors, this does not mean panic selling or abandoning tech completely. It means understanding risk and adjusting strategy. Chasing stocks simply because they have gone up in the past can be dangerous, especially when valuations are stretched. Diversification becomes more important during these phases of the market. Long-term success comes from balance, patience, and awareness of where the market cycle is heading. The real reason big investors are dumping tech stocks is not fear or negativity. It is discipline. They are managing risk, protecting gains, and positioning themselves for what comes next. Markets move in cycles, and smart money always prepares for the next phase before it arrives. The key lesson is simple. Don't follow the noise, follow the logic. Those who understand what big investors are doing are far better prepared for whatever the market does next.